Imagine losing money to a bank and the bank still getting paid. Now, imagine the bank itself starts losing billions. Who protects the bank then? Because banks can fail, but the system around them is built to make sure the damage doesn't spread. And that's where the real story begins. To understand why banks appear so difficult to break, forget the image of a vault filled with cash. Modern banking is not primarily about storing money. It is about moving money, pricing risk, creating credit, and maintaining confidence. A bank sits between people who have money today and people who need money today. Depositors want safety and access. Borrowers want credit. Investors want returns. Businesses want working capital. And the economy needs all of those things operating at the same time. That creates a powerful position. Banks earn income from lending and other financial services, while managing the difference between what they earn on assets and what they pay on funding. They also operate inside a regulatory system designed to protect financial stability. FDIC insurance automatically protects eligible deposits at insured banks up to at least $250,000 per depositor per ownership category. But protection does not mean immunity. Banks can lose money. They can mismanage risk. They can even disappear. The deeper question is what happens around a bank when it begins to fail. The modern American banking system was shaped by repeated financial crises. One of the most important turning points came during the Great Depression, when widespread bank failures destroyed confidence and caused enormous losses for ordinary depositors. In 1933, the United States created the Federal Deposit Insurance Corporation, or FDIC, as part of a broader effort to restore stability. Today, the FDIC says no depositor has lost a penny of FDIC-insured funds since the agency was created. That statistic reveals something important. Deposit insurance changes human behavior. If people believe their insured deposits are protected, they have less reason to panic at the first rumor about their bank. That makes the banking system less vulnerable to sudden withdrawals. Then came another layer: the Federal Reserve. The central bank can provide discount window loans to eligible depository institutions facing temporary funding pressure, with loans secured by acceptable collateral. The Fed describes this facility as a backup source of funding and a safety valve for liquidity in the banking system. So the system evolved from simply letting banks take risks and fail into something more complicated. Banks take risks inside a network designed to contain the consequences. Silicon Valley Bank became one of the clearest demonstrations of how a bank can fail and how the system responds afterward. The bank had grown rapidly while serving a concentrated technology and startup customer base. Its balance sheet also contained large holdings of longer-term securities. As interest rates increased, the market value of those securities fell. When the bank attempted to address its financial position, confidence deteriorated rapidly. Then came the run. On March 10, 2023, regulators closed Silicon Valley Bank and appointed the FDIC as receiver. The FDIC transferred all deposits and substantially all assets into a bridge bank. Later that month, First Citizens Bank Trust Company agreed to assume the deposits and loans of the bridge bank. Notice what happened. The bank failed. Its shareholders were not simply rescued. But the banking relationships did not vanish overnight. Depositors were protected, operations continued, and the institution's assets were transferred through an organized resolution process. That is the crucial distinction. So how does the banking machine actually work? Start with deposits. When you place money into a checking or savings account, that balance becomes part of the banking system's liabilities. The bank then manages its assets, such as loans and securities, while maintaining enough liquidity and capital to meet obligations and regulatory requirements. When a bank makes a loan, it does not simply take a specific pile of cash from a vault and hand it over. Modern banking creates deposits through lending, while the banking system as a whole operates within monetary, regulatory, liquidity, and capital constraints. The Federal Reserve defines money broadly enough to include currency and balances held in bank accounts. Then comes risk management. A bank does not normally make one giant loan. It makes thousands or millions of financial decisions. Some borrowers repay, some refinance, some default. Some assets rise in value, others fall. Interest income and fees provide revenue. Collateral can provide protection when secured loans fail. Capital absorbs losses. Diversification reduces concentration risk. And when liquidity suddenly becomes scarce, eligible institutions can potentially use the Federal Reserve's discount window by pledging collateral. The result is not a system where banks cannot lose. It is a system designed so one loss does not automatically become everyone's loss. This system produces an unusual result. Stability becomes part of the product. When people trust their deposits will remain accessible, they are less likely to rush to withdraw them. When banks know emergency liquidity may be available against eligible collateral, they have another source of funding during temporary stress. When regulators can resolve a failed institution, the goal is to keep essential banking services functioning while losses are allocated according to the legal framework. FDIC insurance is central to this architecture. The standard coverage is at least $250,000 per depositor per insured bank for each ownership category. Importantly, FDIC insurance does not protect every financial product. It covers specified deposit accounts, but protection has a price. The FDIC maintains a deposit insurance fund, and banks pay assessments into the system. When extraordinary protection is used, losses can be recovered through mechanisms such as special assessments. In the 2023 SVB and Signature Bank resolutions, the FDIC estimated that protecting uninsured depositors generated costs that were to be recovered through special assessments on banks. So the safety net is not magic. The first lesson is simple. Banks are not invincible. Silicon Valley Bank proved that. Its failure exposed weaknesses in risk management, concentration, interest rate exposure, and liquidity planning. Federal Reserve reviews concluded that management and the board failed to manage important risks, while supervisory weaknesses also contributed to the story. The second lesson is more important. A bank's greatest asset may not be its vault, its buildings, or even its loan portfolio. It is confidence. A bank can survive ordinary losses. It becomes much harder when thousands of customers simultaneously decide they no longer trust it. The third lesson is about incentives. Deposit insurance can reduce panic, but it can also change how depositors perceive risk. Emergency liquidity can prevent a temporary funding shock from becoming a collapse. Regulation can reduce dangerous behavior, but regulation itself cannot predict every future problem. And the fourth lesson is personal. When you keep money in a bank, you are not simply storing cash. You are participating in a financial system with rules about insurance, ownership, liquidity, credit, and risk. Understanding those rules doesn't make you a banker, but it can stop you from being completely surprised when the rules suddenly matter. The next banking crisis may not look like the last one. Money moves faster now. Depositors can transfer enormous sums without standing in a branch. Financial information spreads instantly, and the events of 2023 showed regulators that deposit behavior can change with extraordinary speed. A 2026 FDIC staff study examining the failures of Silicon Valley Bank, Signature Bank, and First Republic found that the IEB largest depositors were significantly more likely to run, while fully insured retail depositors generally did not run before those failures. At the same time, banks are operating in a world of changing interest rates, new technology, cyber risks, and increasingly sophisticated financial products. The future safety net will therefore need to do something difficult. Move quickly without encouraging reckless behavior. That means stronger risk management, better liquidity planning, more accurate stress testing, and faster detection of concentrated exposures. But technology changes the equation too. Artificial intelligence can analyze enormous amounts of financial data. Digital banking can make services faster, yet the same speed that improves efficiency can accelerate panic. The future of banking may therefore depend on one old-fashioned thing: trust. Because technology can move money in seconds, it cannot guarantee confidence. Narration. So, do banks really never lose? No. Banks lose money. Banks make bad investments. Banks misjudge markets. Banks can even fail. What makes banking different is what surrounds the loss. A failed borrower may lose an asset. A failed bank may be taken into receivership. Depositors may be protected within legal limits. Other banks may acquire assets. Liquidity facilities may help healthy institutions survive temporary funding pressure. And regulators may intervene when a failure threatens broader financial stability. Silicon Valley Bank is the perfect reminder. The institution itself failed. Its shareholders were not protected, but the system moved quickly to preserve deposits and banking services, eventually transferring the bridge bank's deposits and loans to another institution. That is the real secret behind the title. Banks don't have to win every battle. They only need a system capable of absorbing many of their losses without allowing the entire financial system to collapse. And that changes the question. The important question isn't, why do banks never lose? It's this: when a bank loses, who absorbs the loss? Because once you understand that answer, you stop looking at a bank as a building where money sits. You start seeing it as one piece of a much larger machine. And that machine is the real story.